Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room from Pierpont, California, live streaming through Ticket Talker. We're going to jump right into the gold market here, trading last at 1785, 86.10 now. It's activated a buy trigger from 1785. This is the buy two level that we're looking at on the daily chart on the left for day traders. A close above 1785 is a buy trigger from the buy two level. When the price comes down into this pivot point, it activates a trade alert on the first time that it crosses that pivot. The artificial intelligence of the variable changing price momentum indicator tells you that when the price comes down into the blue area, as we see here for the daily buy two level of 1785, and below the 1781 buy one level, it is the strongest probability area to enter the market on the long side. You don't want to go short here. You want to either wait until the market finishes this pattern, completes the pattern, finds the buyers that will take the price above 1785, and on the close, it would activate a buy trigger for conservative traders. Aggressive traders can buy it at the market when it trades through 1785. The only difference is you manage your stop a little more actively. We have three levels of stops. For conservative traders, you can use the close below 1785 on the close of the 15-minute bar. Aggressive traders can hold on to the close since you're looking at the buy to level with a 95% probability relative to the implied volatility to the mean, which is a 50-50 standard deviation. The buy to level is a 50-95 standard deviation. So if the signal is activated, you're getting a 95% probability that the reversion to the mean could potentially take the price back up to the average price, which is 1805. If you act on the long signal, the initial targets could be used, which are the levels above, whether it's daily, weekly, monthly, yearly, or otherwise. Depending upon the multiples that you have, you can use these levels to lock in profits. The first target is 1789, 1795, and ultimately the daily target, the daily average, which is 1804. The gold market has activated a signal on the long side for day traders. The silver market is also following the momentum of the gold market, 2763. And the difference is the silver market is trading below the average, which is 2781. So it's neutral to bearish. And it has active the buy trigger of 2720 to 2718. It looks like it came down right into this trend line support And what we're seeing here is a reversion. If we close above 2781, it's going to negate this bearish sentiment, and a close above it is going to activate a bullish price momentum with the targets of 2826 to 2834 clearly defined. Today we have signals in the gold market from the B2 level, and obviously it is going to influence as well the silver market. Today the gold market seems to be leading the way, and the path of least resistance seems to be to the upside. We recommended our traders yesterday to get back on the long side of Bitcoin as the market came down, made a low of 42.40 after 58.22 was the high. This is a highly volatile instrument. It's a digital asset, and you want to measure the volatility here and basically be aware that it is probably, as of now, the most volatile instrument to trade. And so we're using the VCPMI to identify those trigger points. And yesterday, as you can see, the market came down below the buy one weekly level of 44.77. And by closing above it, it activated the buy trigger. We recommended our room, in our private trading room, our traders to get on the long side. Hold your long positions. And if you want to use a protective stop, you can use yesterday's low. Hold your long positions with the objective that the market, I believe, is going to test the highs of 58.22. In the gold market, what you can see here is basically that we seem to be completing this vortex of this descending wedge that we've been trading through. And I think if we can get through this 1812, 1816 area, ideally through the 1826, then we pretty much have an air pocket that can take us up all the way maybe to 1874. Breaking out of this descending wedge, out of the resistance level or distribution area that is identified by the VCPMI, is extremely bullish for the long side. You can see the activity. If you just take a look at the volume, down here, there seems to be a lot of trading going on. And when sellers stop selling, it usually is the capitulation. If we're looking into an area where it's telling us to accumulate now, all the way down to actually 1778, which is the annual mean 1778. Correction, the annual average that we're working with is 18. The 360-day cycle is 1810 on the average. We're looking at a monthly target of 1781. Market is activating also a monthly trigger above 1781. And if we get the market to close above 1810 here, this is going to activate once again the bullish price momentum that can take us all the way up to 1874. These are the large scale of the VCPMI as we take a look at the annual, the monthly and the annual, and even the 9-year cycle is all the way down to 1678. I think one of the key elements that is part of this equation that we're trying to identify as far as the effect of the stimulus into the economy, particularly as it relates to the US dollar as the world's reserve currency. And in general, I think we're talking about all the other currencies as well. The pandemic caused massive economic chaos, needless to say, to the world economies, to the point where obviously now central banks, governments are pretty much in a position where they have no choice but to print as much money stimulus in order to support the economy against any potential systemic risk, any potential implosion of world assets, which could lead us into one of the worst depressions ever in the history of the world. We have exceeded the 1929 crash in multi-dimensional ways. The difference, I believe, that we have now is that we were able to make a transition into what we're beginning to see, obviously, is a virtual world, a virtual economy, creating its own virtual currency. And, you know, if you're not aware, I think for your own benefit, you want to really kind of take a look at the anomaly that we have, which is really validating this tremendous diversion occurring, which is creating a whole new economy, a virtual economy. The old physical economy has collapsed, and what we're dealing with right now are simply the casualties of that damage that was done. And we are dealing now with obviously the necessity for the governments to come in and to support that aspect of the economy, the businesses, Main Street, people that unfortunately have been left behind during this generational wealth gap or distribution, you might say, of wealth disparity in the history of the world. The rich are getting richer by borrowing money at literally no cost, taking the money, buying hard assets, stock market, buying their own stock, reinvesting pretty much money they don't need. And this is the fuel that seems to be coming into the market right now that is changing the foundation of the way, pretty much things were, particularly as we relate to the US dollar, intrinsic value, purchasing power, that all of this monetary necessities that have to short term be applied to the market are truly, truly highly inflationary. The commodity markets are beginning to explode. Soybeans up to 14.28 now. Crude oil is trading above 60 at 61 a barrel. 62, 63. Wow, 63 was the high that we just made. And once again, I want to reflect to just last March, we were at negative 37. What the policies currently, as far as the US dollar are concerned, are very much inflationary. And I think we're beginning to see what the central banks, the Treasury, are looking for is some kind of inflation in the economy to get us out of this deflationary, you might say, implosion of potentially world assets here. We need to have inflation be the savior of the day. We need to inflate assets across the board on a global scale. And so what we have here is artificial stimulus, not economic stimulus, not real growth, but artificial monetary policy to stimulate economy. And what I think all of this potentially is going to bring is an accelerated level of inflation unlike we have never seen before. When you really think about the number of people under lockdown, unemployment, and so on and so forth, that we seem to be now beginning to see somehow the light at the end of the tunnel in terms of coming back into some kind of normality. First of all, one of the reasons why we're beginning to see commodity prices explode is because we are running out of supplies. We're going to be faced with a food shortage. As it is right now, millions of people are dealing with food shortages because of the pandemic, the economic crisis. There's no money for food. Millions of people are still unemployed. They fell into this uh, wealth distribution gap, and unfortunately, got the worst of it unexpectedly. None, none of their doing. So, whether we like it or not, inflation is our salvation. And this is the way that we're going to pay. And when I say we, it's always the people paying for the mistakes the governments make in terms of monetary policy, economic policy, and particularly when we're dealing with a natural, unprecedented development. It is always uh, the time when we see the system, the underbelly of the system. And I think the pandemic really uncovered a tremendously public health system globally. We're not prepared for major health crisis, catastrophes like we saw, like we are witnessing, experiencing, like the pandemic. Texas right now pretty much validated and confirmed the fact that the grid is very vulnerable. The infrastructure of America is falling apart. And if we're going to see some kind of economic recovery, I think we do got to focus on where the jobs could be created. And that's in America, building the infrastructure again. But what shows here is that not only the state of Texas proved to be very vulnerable in its, you know, grid and in the ability to weather, no pun intended, a natural, catastrophe, weather catastrophe. Um, it's uncovering a lot of weaknesses in the system, and I think it's just going to get a lot more worse before it gets better. And unfortunately, the way the governments do here things is, when it's broken, fix it. But why fix it if it's not broken? We're dealing with a whole new environment that is very similar to 1970 as far as the inflationary potential and expectations are concerned. And also the difference between relating higher interest rates bearish for the precious metals has shifted into a different relationship. If you look back in 1970, the price of pretty much gold went up from 1971 after they lifted the gold standard to from 35 an ounce all the way to, $800 an ounce. Even going back to Roosevelt at 35 an ounce. In 1981, we saw gold trade $800, $900 an ounce. Interest rates were at 14%. They went up to 14% during this time. And during this time is that we saw, as a consequence of Nixon lifting the gold standard, inflation rampant in the US. And at the same time, interest rates went up, as well as the price of gold. So the fact that we have seen short-term rates a bit rise right now is probably the market telling us that it is asking for more interest as a consequence of the risk in buying U.S. bonds. The stimulus that's coming into the market is not bullish for U.S. bonds. Inflation is not a friend of U.S. bonds. Higher interest rates is not a friend of U.S. bonds. We have accomplished the target of 1795 here, as I've been railing on here. And if you are long in the market here, you want to use a trailing stop, well, you'll pretty much take your profits at 1795. If you went long and you activated the signal, as we recommended earlier, the signal went long at about 90, 80, 87, and we went up to a high of 95. So you had plenty of time to lock in a profit here. If you have multiple positions, then you take some out here. I recommend, if you have $300 of profit on the position, to take it. If you have multiples, take profits at the first target. If the market activates another signal above that target, you can add that position or add more. So this is the methodology and application of the variable changing price momentum indicator. Silver has traded through the average of 2781. Now closing above 2781 is going to activate a bullish uptrend, a bullish trend momentum. The silver market in particular has been on the headlines here for the past few weeks, since pretty much raided GameStop and AMC and some other heavily shorted stocks. They moved into pretty much the silver market. And I think what they have identified is the tremendous weakness in the system. That essentially the physical market is tight. You cannot buy large quantities of physical silver. And it's beginning to build momentum. The premiums are going through the roof. You cannot get physical silver delivered or gold without a long wait. And it appears that the market is beginning to build a major shortage in the physical market. London warehouses are running very low on supplies. In the market is beginning to question, how is the COMEX going to deal, with the possibility that we're going to be running into this tremendous shortage as we did back in March. So we have a lot of trading going on right now between the players, the powers to be here, trying to control the price of gold, preventing it from trading above 1900 again, particularly in the silver market that has the biggest short position by central banks at record levels. And they were able to yesterday bring the price from above $28 an ounce to under 27.50, killing a lot of those options that had been accumulated between the 27.50 and 28 strikes. classic example of how they were able to influence the price down to exactly where those options would expire worthless. And now we're trading $30 above those prices, you know, $30, $40 above it, and we're beginning to inch our way back up to the $1,800 handle that I believe is a very strong handle for the gold market. We're trading now the real market. Now is the time to be buying into this correction based on what the market is saying, not what other people are saying, not what the chatter is saying. $17.59 was the low yesterday. $18.15 was the high after that. $18.16 was the target today for the sell one level. So I liked the action that we saw here today, and I'm focusing in the gold market because today I think the gold market is leading the way now that we rolled out of the March contract into the March silver contract into May silver contract. And we're beginning to get the derivatives of the market supporting the fact that I believe we have seen the correction completed here, this counter trend correction completed. So where do we go from here? I think if we're looking at silver, you're looking at about 28, 26 as the next level where we want to see the trading, you know, at that level here. As you saw here last night, we got up to about 28.42 and experienced a lot of selling, a lot of resistance, a lot of supply, which is what the AI tells us here, that if we get up to 28.34, we can expect supply to come into the market. And of course, it validated that, and it also confirmed the price wanted to come down back to the mean, potentially below the mean, not quite, with the muscle of the short side to bring it down to 27.18, 27.20, and found the buyers at those levels. Reverted back up above the mean. And of course, as I say, trading above the mean is choppy. Don't trade above the mean. Wait for the price either to come down to the extreme below the mean or to the extreme above the mean. That's what we recommend our traders in the trading room, the private trading room. So we want to continue to hold, obviously, the long side. The target from 85 to 95 was completed from the B2 level daily early on the gold to the buy one level, which is the next target above 1795. It completed that pattern. It completed the trade. So it gave you a chance to lock in a profit here. Yeah, anywhere from, $600-700. Not a bad day trade. As we've been talking, as we've been having this conversation, well, actually, me rattling on. Conversation is a two-way street. If you have any questions, just send the questions to Ticket Talk, or let's have a conversation. If you have any questions at all about some of these things I'm coaching you and teaching you here. So the daily pattern, as you see here, pretty much was completed from 85 to 95. That's a 10-point move. If you went to the signal and you took the signal, even on the conservative side, you had a chance to make $300-400. And now it's back to the neutral zone, 50-50 standard deviation, trading around the average of 1780, 85, 89. Almost catching up to the silver market, as you see here, doing the same thing from the average price. Let's just continue to watch the trading here a little bit and see what the market wants to do here, as we've accomplished the signal in the gold market, from that the buy one level, the buy two level of 1785. 85 to 95 was completed. We're back to neutral again. One of the things that I am definitely noticing here as a trader, okay, is the sentiment of the market out there is so extremely bullish. Precious metals, unlike any other time in the history of these markets that I have seen, particularly in the silver market. And I am really surprised that based on these fundamentals that we have of a tremendous shortage of supplies, that the gold market is and the silver market are the most oversold markets, undervalued markets, assets across the board, particularly with the moves that we've seen in virtual currencies, even in some of the other assets and some of the other metals like platinum, palladium. It's very frustrating for the long side, for the longs. And knowing the gold market, trading it for many, many years, the market will go when everybody gives up. The gold market, the precious metals markets do not go up when 99.9% of the sentiment is bullish. And even though the fundamentals do support that prices should be much higher, the bus is overcrowded, ladies and gentlemen. There are too many buyers in the gold market, in the silver market, in situations like that. I would say to you, expect some kind of a shakedown, a major shakedown to occur. The metals do not like company. and they go when nobody expected. And so we have an anomaly going on between the short players in the market, which are commercials that have the lid on the price of silver. They have the lid on the price of most commodities, gold, silver in particular, as we talk about the monetary cousins, you might say, of the US dollar. The gold market is the other side of the US dollar. And I'll tell you, the gold market is not dead. The silver market is not dead. In fact, this suppression of price, this manipulation of price, is only going to result in a violent reversion to the real mean of the price of gold. And that real mean is pretty much skewed. It has been skewed since 2012 when they when the powers to be eliminated the optic rule. This is what most traders do not understand, why this massive short position is allowed to be accumulated is because they eliminated the optic rule. And by not allowing the optic rule to come in, these short sellers can continue to pound the market using algorithms. Once it kicks in, they are relentlessly pounding the market, selling paper trades that basically have nothing to do with the reality of production, particularly in the silver market. So what we have is a massive short position by commercial banks that exceed $40 billion during a market that is extremely tight in the cash market, in the physical market. And all the weakness that we have that is being reflected on this is in the paper market, which is controlled by the central banks. And so this is the fight between the longs and the shorts. The demand in gold and silver is unprecedented. Again, you cannot buy physical in large quantities, particularly without having to pay a huge premium. So the only place basically that you have is to go to the futures markets. And we see that. We see that in the other category in the Commitment of Traders report. But we also see, like we saw yesterday, that every time, particularly with option expiration, the strike gets into a major level where this banks could stand to lose tremendous equity. You see this price activity that doesn't make any sense. Under the fundamentals, to see the gold market trading at 1788, 89 is ridiculous. To see silver trading at $27, $26 an ounce is completely ridiculous. Particularly if you price it, to the debt, if you price it to Bitcoin, if you price it to interest rates, it is completely ridiculous for the price to be trading at these levels. And I think it's just a matter of time. But we could see, massive liquidation, massive shakeup of the tree of the longs, test the strength underneath, and wipe out those that are weak buyers, nervous Nellies, until eventually you get into that ceiling now that is getting higher and higher or the lows are getting higher and higher, which means that the buyers are stepping in and paying a higher price for gold and silver. I want to comment on if you get a trade like we did in gold right away, and you got to measure obviously every trade that you do, and the market goes up $1,000, you know, I don't know what you're waiting for, but if you don't take it, I think you're getting a little bit too greedy. When you get out of a position or you get stopped out, wait until the highest probability to trade. And if you're trading, if you decide to trade around the average price, then you have to be more active in trading it because it's choppy. It's 50-50 standard deviation. Personally, I want to trade the highest probability trades, and that's again buying from the extreme below the mean of B2 and selling at the extreme above the mean, which in this case was 1795. So if you didn't take that 1795 target, as I've been saying here, you're not following the algorithm. You're not following the momentum. You're trading on your own, using the algorithm as an excuse. You're not following the pattern. You're not following the methodology. I told you here, buy 1885, close above, take your targets 1795. It's that simple. There's nothing to question on the day trade. The signal is neutral now. There is no signal. It accomplished that previous target and signal. Same thing with the silver. There's no signals now for the rest of the day for day trading. 75.50 for silver, 76.50 trading it. It's 27.81 is the average, and if we get above that average, it's going to activate the bullish trend momentum. 28.34 is my target. Now, if I'm not trading in the futures contract, okay, because there's no signal, I'm not going to miss anything because I am long in my core position. And this is how you can create the intelligence according to your profile so that you can scalp the signal, you might say, in day trading it. And you can also swing your position or even position it on a longer term basis, being able to capture the underlying trend of the market, but managing your risk more actively in the futures contract. So if I take a trade and I get out, I meet the target in futures, why do I care where the market is going in the futures contract? Because I met my target, I met my trade, I accomplished my goal, my objective. And if it goes above my price that I got out at, I am not losing anything because I am carrying in a core position. This is what I need my traders to understand in Discord. This is how you keep the overall trend of the market in your favor. You have to make that distinction. Trading above the average price, again, only confirms that the weekly bullish trend momentum is bullish. The thing I want to point out very clear that most of this application or methodology requires a lot of discipline, and it's a simple basic methodology that is consistently following the same format, the same patterns, the same thing over and over again. When the patterns are identified, the signal is activated. It provides for you the targets above or below. If you enter the signal, use the target above as your initial target. There's nothing to question. It's there if you're day trading. If you're doing multiples, you can use these levels to liquidate partial profits of your position. If you're doing one contract, there is only so much that you can do. And when you're only doing one contract, you take your profits as fast as you can, as quickly, and book them. Emotion is what will get you into trouble. Fear and greed will kill you. Be systematic in approaching this. The VCPMI is an intelligent trading tool that you can use to guide your trading. The only difference is that you want to be disciplined about following, just like when you use a GPS. Continue to hold your long derivatives. Continue to trade from the long side on any corrections into the levels of support indicated by the VCPMI in blue. Thank you, everybody. Thank you, everybody, once again for allowing me to spend this time with you. And I'll see you next time. Take care of yourself, please. Be well. See you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here.